Hey Canopy Growth traders and investors, it's Rod with Pow Group. Welcome back on the Pursuit of Wealth, your home for MJ stocks, crypto assets, news, and interviews. Also home to the best MJ community. Today is Friday, December 1st. It's a brand new month, and happy Friday. Hope you're doing well. And in this video, we're going to be discussing Canopy Growth and BioSteel. They announced today that they completed the sale of BioSteel, so we're going to discuss all of that and more. We've also got a video from BNN Bloomberg, and we're going to take a look at an interview from the CEO, David Klein. Before we get to it though, make sure to smash the like, help support me in the channel. Doesn't cost you anything. If you're new, you can subscribe, tick the bell, all that good stuff. You'll be notified on any future videos or whenever I go live. But first and foremost, this is not financial advice. This is for entertainment and informational purposes only. You should never, ever buy anything based on anything that I write or anything that I say. Also, make sure to give us a follow over on X, which is formerly Twitter. The handle for that is @GroupPow. Going to be using that as my platform of choice going forward. So this is the article that was announced today. Dated December 1st, Canopy Growth announces completed sale of BioSteel business. So realization of sale proceeds further strengthens Canopy Growth's balance sheet. The completed transaction further advances Canopy Growth's MJ-focused asset-light operating model. And they announced the two sale transactions referring to the assets of BioSteel Canada and BioSteel Manufacturing LLC. They completed for aggregate gross proceeds of $30.4 million. Pursuant to CCAA court-ordered sale and investment solicitation process, a sale of substantially all of the assets of BioSteel Canada to Coachwood Group as contemplated by an asset purchase agreement dated November 9th, 2023, and a sale of substantially all of the assets of BioSteel Manufacturing to another third party as contemplated by an asset purchase agreement dated November 9th, 2023, have completed. A portion of the proceeds realized from the two transactions will be used to repay debt, which is expected to further reduce interest expense. And then we have a comment here from Dan Crosby, the founder and CEO of Coachwood Group. The BioSteel brand is loved and continues to serve professional athletes and has evolved beyond to cultivate a passionate and athletically inspired consumer base. He said in a statement, "I am dedicated to continuing to deliver high quality products under the BioSteel brand that everyone loves for years to come." And then here was the BNN Bloomberg article reporting on it as well. I did want to highlight just a couple key points here. So the first deal involved the sale of BioSteel Canada to DC Holdings, as I mentioned, which does business as Coachwood Group of Companies and also owns sport nutrition brand Canadian Protein. The second transaction saw BioSteel sell its manufacturing business to New Jersey-based Gregory Packaging, which is behind SunCup juice cartons, which let me know in the comments below if you're familiar with those, but I hadn't heard of them before today. But let's take a look at this article or this interview from this article with CEO David Klein.
Well, let's take a long-term look at Canopy Growth. At one point, this is a company that was worth more than $20 billion. Today, it is valued less than $500 million, and some analysts are worried it's fighting for its life. Now, today, we're seeing shares trade lower this morning, even as the company grew sales more than expected. The marijuana producer has been working to get its house in order, cut costs, become profitable, focus on growth in cannabis. Except right in the middle of the business is a sports drink and protein powder business, BioSteel. BioSteel delivered huge sales growth, but was also responsible for 60% of the losses this quarter. Let's bring in David Klein, who's the CEO of Canopy Growth. David, thank you so much for being with us. It's hard to maneuver around this thing that is BioSteel. It's delivering such tremendous sales growth, but is losing you money. How does that happen?
Yeah, so to build a CPG brand like BioSteel takes investment in cash and investment through our P&L. And so when we look at our business and we want to be focused on cannabis, we've said that we're going to review all of our options to eliminate the drag caused by BioSteel from a cash flow and an earnings perspective, because our cannabis business, as you mentioned, we've restructured the business. We focused on an asset-light model, and it's working. We're seeing improved performance from a profitability standpoint across our business. Every single one of our business units grew sequentially quarter over quarter, and so that part of our business is working. And we need to stay focused on that as we go forward.
Even as you say it's working, and I'll quote from a report from BMO where the analyst says they think you need to raise $200 million by 2025 in order to continue operations. Does that mean BioSteel has to be sold by then?
Yes, so we don't have any set timing, but we'll move as quickly as we can. What I would say, as it relates to our balance sheet, we've reduced our debt by over $1 billion. We continue to dispose of non-core assets. We said we would sell $150 million worth of non-core assets, which we would apply to our debt. We've already executed on 80 plus million of that. And so we think we have a lot of levers to pull. We also believe that as a result of our asset light strategy, we come out of this fiscal year with our cannabis businesses being profitable. And then that clearly eliminates any sort of future cash drag from our operations of our business. So yeah, there's a lot of work to be done, but we think we've built a foundation, and a profitable foundation, that we can build on from here.
So through asset sales and right-sizing the business, you think you could be able to plug that hole versus needing additional financing?
I think we have a lot of levers to pull, but it starts with the business needs to be profitable, and then we'll be able to cover any gaps that we have. And I think, another point I would like to make as it relates to our cannabis business is that the cannabis industry, we're only a few years into the game, and it's still evolving quickly. But we think that with the new asset-light business model we have, that we can be a lot more nimble and address that market in ways we haven't been able to in the past.
And let's talk about that cannabis business, edibles, but also in flower. Tweed has been showing some meaningful traction there. Are you able to, grow in market share at the same time that you're able to make it a kind of a more lucrative business from a margin perspective?
Yeah, look, hats off to the team in Canada this past quarter, because we made significant changes in the business. As you know, we've closed down 60% of our grow capacity. We've eliminated 60% of the jobs that the business had over the last couple of years. And yet during that quarter that we did that real hard work, the business was able to grow sequentially and show tremendous improvement from a profitability standpoint. So yeah, and look, we continue to believe in cannabis. You can walk around any major city, using Toronto as an example. Cannabis is ubiquitous. We're seeing the growth of the fastest growing demographic consuming cannabis right now are senior citizens. People between 18 and 24 years old, 69% of them say they prefer cannabis to alcohol. So we still love this industry. It's just it's as an industry and as a company, we're on the path, and we think our asset light model gets us there.
You use the word ubiquitous. I wonder if it's too ubiquitous. The market is saturated with all kinds of different players. At the same time, don't have the pricing power because you still have kind of the black market nipping at your heels. It's a market that seems ripe for consolidation. What role will Canopy Growth play in that?
We'll investigate all of our options. Right now we'll stay focused on driving the brands we have in-house. Our Tweed brand is the most recognized brand in Canada. Wana is the #2 edibles in Canada, and it's one of the top edibles players in the US as well. We'll just continue to drive those brands and string together wins from those brands, because we know we can do that profitably. And then we'll look at all of our other alternatives.
Ear to the ground. I only have 30 seconds left, but any sense on timing of legislation in the United States?
No, I've stopped guessing on that. However, what I would say is with our U.S. structure, with brands like Wana and Jetty and Terrace and Acreage, we're not waiting for legalization, and so those brands are continuing to grow while the U.S. government is kind of grinding through regulations. And we announced recently that Wana opened in 45 locations in Florida. So we're continuing to build our business while we wait.
David.
So as you can see, I believe I shared that video before, but I wanted to share it again. It wasn't that long, but you can see that they're starting to follow through on some of those promises. That's one thing that I really like about Canopy that we've been seeing is they're actually starting to make progress and follow through on what they said they're going to do. And the asset light model, I think, is a great approach going forward. And like I say, it was contributing for a majority of Canopy's loss. So the fact that they got rid of BioSteel was a necessary step, in my opinion, of righting this ship. But as you can see, and what he said was that they have I think it was like 17% from the recent earnings call that they said they have 17% ownership in TerraSen. They also have the ability to acquire acreage once federally permissible. And then they also mentioned that Jetty, they released some vapes under that brand, and I think they were in top 3 in the Colorado market just months after launching. So there's going to be a lot of upside here, but a lot of it is depending on the U.S. reform. And then obviously they had some hurdles with regards to their Canopy U.S. entity. So they wanted to create a holdings company and basically separate Canopy U.S. financials from the main company, because if you're in the U.S., you can't touch the plant itself under a U.S. entity, right? So if you're in the U.S., it has to be a U.S. entity. You cannot be listed on the NASDAQ and touch the plant, right, in the U.S. So this is something that they have to circumvent and kind of figure this new special purpose vehicle, I guess, if you could call it that. But there's going to be more and more companies that start to do this, but it's very slow going, right? This involves the regulatory body, the SEC, the Securities and Exchange Commission in the U.S. It also requires the NASDAQ approval and Canopy Growth working with all of them, right? So it's all of them working together. It's definitely not going to be a fast process, but if they do manage to work this out, then like I said, it's going to be huge. And then it would also pave the way for other Canadian companies to do a similar thing. Because as we know, if you're listed on the NASDAQ, you're listed on the NYSE, there's laws and, well, there's regulations, right, with regards to being able to touch the plant directly in the US. So we'll see what happens, but it's certainly looking like, like they said, they were looking at offloading some of their assets and focusing more on MJ. And then today's news, like I said, with the completed sale of BioSteel, like I said, is just reinforcing that they are on the right path, in my opinion, and focusing on MJ and focusing on their brands, which are ultimately what's going to make these MJ companies successful long term. But I do think that Canopy is going to be one of the long-term winners. I think they're going to have what it takes to come out of this on top. And I'm a full disclosure, I'm a shareholder of Canopy Growth. It's a little less than 10% of my overall MJ holdings. I am bullish on it for the long term. I do think that the risk versus reward is absolutely favoring reward. We do have to realize that they have until about mid-January to regain compliance with the NASDAQ minimum bid price rule. They did approve a 15-to-1 reverse split, but they could get a 180-day extension. So if I were to, again, I'm not in the prediction business, but in my opinion, this is just my own thoughts and opinions, I don't think that they're going to reverse split. I think that they'll get an extension of 180 days, and then there's enough catalysts on the horizon to organically get back above $1, right? I think, and we almost hit $2 just on the HHS recommendation, monumental recommendation to Schedule 3. So if we get DEA approval of that, and it actually gets rescheduled to Schedule 3, that's going to create enough hype. The MJ Act is up for review here in Canada. We could see safer banking uplisted to NYSE and the NASDAQ. We have Germany coming online. Also, Canopy just got its EU GMP certifications from the Kincardine facility, so they'll be able to do exports and things like that into Europe, and that's going to be beneficial ahead of German legalization as well. So there's a ton of catalysts on the horizon. I think that the most likely scenario is they get an 180-day extension, and then they get organically above $1, right? But we can't rule out the possibility of a reverse split. That's possible. I just don't think it's the most likely scenario. But let me know your thoughts and opinions in the comment section below. All right, going to end it there. It's Rod with Power Group. Thanks again for joining us in the pursuit of wealth, and we'll see you again on the next video.